Hello everyone and welcome back to the channel. Today we are embarking on a journey to create a hypothetical investment portfolio with just $10,000. This isn't just about numbers, it's about understanding the strategy and reasoning behind every smart investment decision. So let's dive in and see how we can make the most out of this amount.
I'm not fucking leaving!
Alright, let's say you have $10,000 to invest. The first step is to think about diversification. Diversification is crucial because it helps manage risk by spreading your investments across different types of assets. This way, if one investment doesn't perform well, others can help cushion the blow. It's like not putting all your eggs in one basket. This strategy not only protects your portfolio, but also allows you to benefit from the various market sectors. My strategy focuses on balancing growth and income. I believe in having a solid core of growth stocks and ETFs complemented by reliable dividend payers. This combination aims to provide capital appreciation while generating income. By blending these elements, you can achieve a steady growth trajectory and enjoy regular income payouts. For this hypothetical portfolio, I'll be mixing some of my favorite ETFs and a touch of real estate to ensure a well-rounded approach. Let's talk a bit more about why balancing growth and income is important. Growth stocks are typically companies that are expected to grow at an above average rate compared to other companies. They reinvest their earnings into expansion, innovation, and market share. On the other hand, income stocks are generally established companies that pay out a portion of the earnings as dividends. By combining both, you're positioning yourself for capital gains while also generating a steady income stream.
It's an evil world we live in.
Let's break down the 10K allocation. First up, we are putting 40% into VOO, which is the Vanguard S&P 500 ETF. This choice gives us a solid foundation by providing exposure to 500 of the largest US companies. It's like owning a piece of America's biggest and most successful businesses, from tech giants like Apple and Microsoft to consumer staples like Procter & Gamble. Historically, the S&P 500 has delivered average annual returns of around 10%, making it a foundation of many investment portfolios. Next, we're allocating 30% into DGRW, the iShares Core Dividend Growth ETF. DGRW focuses on companies with a track record of consistent dividend growth, perfect for those seeking a steady stream of income. With a minimum of 5 consecutive years of dividend growth, DGRW ensures we're investing in financially healthy and mature companies covering a diverse range of sectors. Following that, we're placing 20% or $2,000 into SCHD, the Schwab US Dividend Liquidity ETF. This blend of growth and income targets high-quality dividend stocks, providing stability and potential for capital appreciation. Finally, we're dedicating 10% or the last $1,000 to VNQ, the Vanguard Real Estate ETF. Now, some of you might be taken aback by this choice, but let me just explain. VNQ offers exposure to the real estate sector through REITs, which are companies that own and operate income-generating real estate. This not only provides further diversification, but also acts as a hedge against inflation. I have a video going over REITs if you guys want to check that out. With that in mind, historically, real estate tends to perform well during inflationary periods, making VNQ a valuable asset in our portfolio. Each of these selections serves a purpose: VOO for broad market exposure, DGRW and SCHD for a mix of dividends and growth, and VNQ for diversification into real estate. This diversified approach aims for a balanced risk-return profile, allowing us to navigate different economic cycles and market conditions effectively.
I love you, bitch. I ain't gonna never stop loving you, bitch.
Now, let's dive a bit deeper into each of these ETFs, starting with VOO. It's one of the most popular ETFs for a reason, and I've made multiple videos explaining why. It offers low expense ratios and high liquidity, making it easy to buy and sell. Plus, by investing in VOO, you get exposure to companies like Apple, Microsoft, and Amazon without having to buy individual stocks. Moving on to DGRW, this ETF is fantastic for those who want to focus on dividend growth. Companies within DGRW are required to have a history of at least 5 years of dividend increases, ensuring they are financially stable and committed to returning value to shareholders. This can be particularly beneficial during market downturns, as dividend payments can help offset losses. SCHD is another excellent pick for dividend investors and one of my favorites. It screens companies based on financial strength, dividend yield, and dividend growth, offering a balance of high yield and growth potential. Its low expense ratio is an added bonus, keeping more of your money invested rather than paying fees. Lastly, VNQ offers a way to invest in the real estate sector without having to buy property directly. REITs included in VNQ are required to distribute at least 90% of their taxable income to shareholders, providing a steady income stream. Investing in real estate through VNQ also offers liquidity, which is not always possible with direct property investments.
Unnecessary dick riding, 10 yards.
Now, let's discuss managing risk. Investing always comes with ups and downs, but diversifying helps mitigate some of that risk. It's also essential to regularly review and adjust your portfolio based on market conditions and personal financial goals. For instance, if one sector outperforms and takes up a larger portion of your portfolio, you might want to rebalance to maintain your desired asset allocation. Remember, guys, that investing is a marathon, not a sprint, and consistency and patience are key to long-term success. I've had my fair share of market volatility. It's crucial to stay disciplined and just avoid the temptation to make impulsive decisions based on short-term market movements. With that in mind, staying disciplined can be challenging, especially during market volatility. Here are a few tips that have helped me. First up, set clear goals. Think about why you're investing. Is it for retirement, buying a home, or something else entirely? Having a clear purpose keeps you focused and motivated. Secondly, stick to your strategy, stay focused on your plan, and don't get sidetracked by short-term market swings. Thirdly, regularly review your portfolio. You can't just invest and not keep an eye on your investments. Check in regularly and adjust if needed, but don't let day-to-day noise dictate your guys' decisions. Lastly, and most importantly, educate yourself. The more you understand about the market and your investments, the better decisions you'll make in the long term.
You already know what's going on, dog. Hey, I made pancakes.
Looking at historical performance, a portfolio like this has the potential to grow steadily over time. VOO has a strong track record of capital appreciation. DGRW and SCHD provide growing dividends and potential capital gains, and V&Q offers real estate exposure and income. However, it's important to remember that past performance isn't always indicative of future results. Market conditions change, and there will be periods of volatility. The goal is to stay diversified and keep a long-term perspective. By sticking to your investment strategy and regularly reviewing your portfolio, you can navigate market fluctuations and work towards your financial goals. So there you have it, guys, a hypothetical 10K portfolio that's diversified and designed for steady growth. I hope this gives you some valuable insights into how you can structure your own investments. I'd love to hear your thoughts. Drop a comment below and let me know how you'd invest 10K. If you enjoyed this video, don't forget to hit that thumbs up, subscribe, and ring the bell to stay updated with my latest content. Thanks for watching, guys, and I'll see you guys in the next video. Also, we reached 34 subscribers, or we got past 30 subscribers, so I just want to say thank you guys for that. And that's it. Bye.
My hope in you.